can. I can hear you on Facebook.
Hi, good evening, everyone. I hope you can hear me well and see my PowerPoint presentation. Thank you. Hope you had a good dinner and are ready to join us this evening in this journey of Ask Me Anything. Should I still invest in bonds? Welcome, welcome. This is the inaugural session of IFL's Ask Me Anything series. We hope in the coming weeks and months that we would be able to have a regular forum comprising of different topics. So I encourage you to keep in touch with our Facebook and join us on a regular basis to ask our panelists questions that you may have about different financial topics. We already have questions that have been asked earlier before the session started this evening. We will be answering those questions, but more importantly, this is meant to be a live interactive session. So do put in your questions in the Facebook comments page. My colleague would put priority on those questions. We would transfer them to Slido. You will be able to see the questions as I answer them. So let's have some fun. Who is IFL? So we are an education institute founded by Money Sense and Singapore Polytechnic Enterprise. Our remit is to provide free and unbiased education to members of the public. As a result, we will not be providing any financial recommendations, nor financial advice and opinions, or answer any question about recommendations on products. So your questions this evening, I hope you could respect that mandate of ours. Should you have any inclination to act on information this evening, we highly recommend that you consult a licensed financial advisor. Any mention of companies and industry is purely for illustrations purposes and for education and illuminating certain points. So let's jump right in. If you have seen the EDM promoting this event, this would be the tagline you have seen. Many investors see bonds as a safer investment tool compared to equities. With the recent bond defaults, are bonds still attractive investment? I would have to say that the answer remains yes. There is a time and place in everybody's portfolio, investment portfolio, to have some bonds inside. Having said that, low risk doesn't mean no risk. So bonds are generally less price volatile compared to equities, and as a result, considered to be lower risk. But at the same time, if the bond issuer were to go bankrupt, default, then the risk of losing your money could be very significant. So do remember this, low risk doesn't mean no risk. Then the other questions like, should you buy bond funds, ETF, how to decide, Singapore savings bonds and things like that? We will be answering these questions over the course of this evening. My name is Swee Chew and I represent the Institute for Financial Literacy. And before we go into the question and answer segment, we would like to take a step back and look at some of the basics of bonds investing. So allow me to show you a few slides to just introduce you to some basic elements and basic principles of what I am talking about. So why do people invest in bonds? The main reason really it's because it provides the investor with a recurring passive income, because most bonds would pay a regular interest or coupon, typically 6 months. And as a result, when you add bonds to other risky securities in your portfolio, it will reduce the overall portfolio risk. Some people may say that in today's context, bond prices, equity prices, or asset prices tend to be correlated and move in the same direction. That may well have some truth, but we are not about to put 50 to 100 years of research knowledge into the bin. I think we need to also take a bit of a perspective here. So from an investment perspective, education perspective, then bonds combined with equities will reduce portfolio risk, so diversification. Finally, bond prices can also fluctuate with interest rates, so there's a possibility of making some capital gains and of course also some capital loss. And if you hold a bond to maturity, which is what a lot of investors, retirees do, then unless the issuer bankrupt or default, then you will be able to recover get repaid of the face value of the bond. So having looked at why people invest in bonds, is probably good to take a look at what are some of the risk and the downside of bond investments. So our next slides will focus on risk of investing in bonds. The most important is default risk. If you have ever lent money to people, you would know that the most important thing is to get your money paid back. After that, then it would have to be interest rate risk, because bond prices and interest rate move in opposite direction. When interest rate rises, bond prices fall, and so therefore bond interest rates have a significant impact on bond prices. And then the other important risk would be inflation. Bonds are typically fixed rate, and so therefore not a very good hedge against inflation. The other risk would be liquidity and issue specific. When you are investing in a bond and then you find that the investment did not pan out as you expected and it's turned sour, what would you do? I think it's an important question to contemplate. The most important thing is to get organized. When investing in bonds, just like investing in any investment, it is important to monitor and keep track of development. And when you don't see things moving the way it should be, take action. One of the good things, the appropriate thing to do is approach the trustee of the bond. So every bond will have a trustee. approach them, find out more information, seek legal advice, turn to the people who sold you the instrument, your financial advisors, the bank who arranged the bond issue, ask them for what's happening and ask them next steps. These days, advocacy group like SIAS, Securities Investor Association of Singapore, are also taking a very active step to help retail investors. You can also approach them for advice. And if you do find out relatively early in the process, then consider selling, exit. If there's still liquidity and a good price, sell out, reinvest the money into something else, all right? You may have to take a loss. So what sort of due diligence can you do when you're looking at bonds? First and foremost, retail bond issues have a lot of materials, investor information in the form of prospectus. If the prospectus is too difficult to read, then read the simplified offer documents that comes with the listing process, especially the product highlight sheets. Now, some of you would know that the Temasek's subsidiary Azalea issued a new bond, Astrea VI, today. In the Straits Time, you will have a full page of graphics on the highlights of the bond. So if you're planning to invest in that, take a look at that highlight sheet, find out more information. Try to understand the ranking of the bond in liquidation, meaning to say if things were to turn really, really bad and the issuer were to go belly up, how do you rank, right? So in the case of Hyflux, there are the senior bond, and then there are the junior perpetual bond holders. So obviously the senior rank ahead of the perpetual, at least in theory. Understand the structure of the bonds. What are the clauses? Redemption option, interest step up. So Astrea has a 10-year maturity, but with the 5-year mandatory call by the issuer if you meet certain certain conditions. So which means to say that you could get your money back as soon as 5 years, but in the worst case, 10 years. And if you don't get the money back at year 5 during the mandatory call, there's actually a step-up interest to reward you for continuing or to penalize the issuer for not making the term. So these are the terms that you need to find out and be familiarized with. Ultimately, when an issuer borrows money through a bond, it is to invest. It is to invest with the monies, right? So be satisfied with the use of the proceeds. If the proceeds are used in a productive way, then your investment would pan out. Finally, do financial checks, ratio checks, and comparative studies. Compare against other issuers in the industry, do a financial analysis to make sure that you are comfortable with the credit risk of the bond. Okay, so those are the few slides. Let's move on to the more interesting segment of this evening's session, which is the Q&A. So I do encourage you, if you not already are doing so, to put in your questions and comments in the Facebook comment section, and then my colleagues would transfer that into Slido. You don't have to worry about that. We will project the questions on Slido, and I will answer the questions accordingly, and you will see the questions being answered. Priority will be given to the live question asked this evening, although we will answer some questions that were asked earlier. So with that, I'm going to stop share and let my colleagues have a few seconds to turn on Slido so that we can see the questions. Okay, so you should be able to see the Slido questions in a short while. Okay, all right. So question number 2, should retirees invest? So the question is relatively broad, and I'm assuming that the question is asking, should retirees invest in general, right? So all sorts of financial instruments. The answer is definitely yes, right? So we should generally invest our surplus monies other than the emergency liquidity that we keep for rainy days. Depending on our financial objective, then we should invest our monies differently according to the objective and according to the investment horizon. Because when you're not investing the money, it is difficult for the monies to grow using the power of compound interest to meet the financial objective that you have. Retirees are going to be older, so generally probably in the 60s, maybe even 70s. Life expectancies of Singaporeans here, it's about 85 years old. So in terms of investment horizon, the retirees probably don't have a very long horizon. So we are talking about 15 years, maybe 20 years, or even 10 years. As a result, retirees should invest in relatively safer instruments, safer securities, so that when there is market turbulence, there is enough, or rather, it would not affect the retirees too significantly. If you are younger, then you have a much longer runway to ride out the market turbulence. Generally speaking, retirees should invest in safer, lower risk instruments. Bonds would figure quite heavily. So there is a back of the envelope rule that says that the percentage of bonds in your portfolio should be equal to your age, roughly. Okay, so which means to say that if you are 75 years old, then 75% of your portfolio in bonds, and then the other 25% in equities or higher or more risky securities. Okay, so that's the question on retirees investing. Next question. Okay, which bonds foreigners can invest? Which bonds foreigners can invest? So generally speaking, you need to find out the bonds, right? What sort of restriction there may be for investors, what sort of funds it can or it cannot take. So for example, some of you with CPF monies may or may not be able to buy certain category of bonds. So if you're talking about, for example, Singapore government bond or Singapore savings bonds, then locals and foreigners can buy, but corporations cannot buy Singapore savings bonds. So you need to look at the criteria for the bonds, all right, in terms of the investor type, and also in terms of the pool of monies that you can invest from. Okay, so looking at the top question, equities have higher portfolio returns, I guess higher financial returns. Why should we invest in bonds, i.e. S&P has strong returns over long term? As I mentioned just now, bonds added to a portfolio of securities would dampen the volatility. So for example, if you are going to retire, let's say in the January of 2009, right? And 5 years before the January of 2009, you reconfigured your portfolio to mostly equities to take advantage of the returns. What would happen is that come January 2009, we all know what happened then. The great financial crisis happened. All the financial, especially equity markets, would have tanked very significantly. Then if you're going to retire that year, then you're going to struggle in terms of your retirement portfolio. So therefore, even though equities have higher returns in general, you need to also pay attention to your investment horizon. So those who are investing for the longer term, then you would need to be able to then invest, okay, with some equities and some bonds. Okay. How does bonds ETF work? How does the bonds ETF work? So ETF stands for exchange traded funds. Exchange traded funds. So the word funds means that ETF is like mutual funds or unit trust. So it's a collective investment product. So instead of a unit trust, which is not listed, bond ETF is then listed. So if you are not comfortable with buying individual bonds, then because you are not able to evaluate individual bonds then comfortably, then you need to look at collective investment instruments such as ETFs and such as mutual funds. Okay, bond mutual funds. Next question, with interest rates so low now, will we expect to rise eventually? Is it a confirmed lose case to invest in bonds now as bond prices is inverse of interest rate? So it's very difficult to catch the interest rate, right? Because interest rate is a function of many economic factors, some of which are not totally predictable and within our control. In the past week or two, interest rate was quite volatile, mainly because of the concern about the or rather the economy being overheated and inflation coming back. So during that short period of time when the interest rates were rising, okay, in the last couple of weeks, then yes, of course, bond prices will fall. So which means to say that you need to take a look at your bond your investment horizon and invest accordingly instead of trying to time the market by looking at the current conditions. But having said that, when you are buying bonds, there are some more complicated concepts called duration. So that is the measure of the sensitivity of bond prices to changes in interest rate. So in an interest rate environment where you are expecting interest rates to stay low, then you want to buy more volatile bonds. And if you're expecting interest rates to go higher, then obviously then you buy less volatile bonds, okay? But duration is a much more complex subject that I can't really cover in great amount of detail this evening. Okay, so the next question, are there current valuation of mini bonds in the current market that we should watch out for? So mini bonds, you are referring to the term that was used or popularized during the periods before 2009, whereby it is a structured product whereby they repackage different bond obligations into a credit default CDO, a credit default obligation. So basically, it is a structured repackaged structured product. The structure in itself may not be bad, but what you put into the structure and how you sell the structure or missell the structure could be an issue. So therefore, I would say that you need to pay attention to the details. Pay attention to the details, right? Try to understand how is the structure, how does the structure work, what is packaged inside the structure, and what are some of the risks that you are taking. So look at the offering prospectus, look at the offering documents, and understand the products. If you don't understand the product, then you should avoid it. Next question, does IFL teach options trading and USA stocks investing? So IFL is an educational institute, and we provide information and general education. So we are not a product house. So there are financial outfits out there that will teach you how to do options tradings and investing in US stocks. So this is not what IFL does. Having said that, do not become too overly attracted by the financial returns that you forget about the riskiness. All right. So high returns always comes with high risk. How to avoid a situation like Hyflux? As I mentioned earlier, when you invest in bonds, in fact, when you invest in any financial instrument, there's always risk, right? So bonds may have lower price volatility, but low risk doesn't mean no risk. So in order to avoid a situation like Hyflux, I'm sure the institutions and the regulators are learning from it. But as an investor, I think the point here is that you need to understand what you are buying, understand the company, understand the financial strength of the issuer. And in the case of Hyflux, there's a difference between buying senior bonds and buying perpetual securities. So even though the perpetual bonds were sort of promising higher interest rates of 6% and above, it comes at significant amount of risk. Now, just to share with you a little bit of anecdote, right? I mentioned earlier, if the deal turns south, if there is enough time, sell and get out. A few months before Hyflux finally got into trouble publicly, somebody actually asked me about the perpetual security, and the advice then generally many people were expecting things to turn bad. was to sell, right? It was between $88 cents to 92 cents to a dollar. The person would have lost 10 cents, but they would have recouped about 90% of the capital. The person didn't listen to me, so right now is joining the ranks of many others in terms of trying to get their money back from Hyflux. So invest, but be careful of what you're investing and make sure that you understand what you're investing and match the risk with your investment objective. In a high-risk portfolio, what is a good percentage of bonds in a diversified portfolio? In a high-risk profile, what is a good percentage of bonds in a diversified portfolio? Okay, so generally speaking, a diversified portfolio that is balanced, so it caters to the balanced investor, somebody who is in the middle of a risk profile, would be about 60% international equities and 40% international bonds. So if you are a higher risk profile than that, then your percentage of bonds would drop from 40 to something lower. Okay, it could be 30%, it could be 25%. It depends on your risk profile. But a generally accepted rule of thumb for globally diversified balanced portfolio for the conservative average investor is 60% international bonds, 40% international, 60% international secure shares and 40% international bonds. Question is asked about yield curve, treasury rates, inflation, interest rates. Are you able to simplify their interrelationships to beginners like us? Thanks. So a yield curve is essentially a graph that plots the interest rates of instruments. That is, typically we use the risk-free or the government bonds as a basis for plotting that yield curve. So on one axis, you will have duration, 1 year, 2 year, 3 year, 5 year, 10, 20, 30 years. On the other axis, you will have the interest rate. So different tenure of the government securities will correspond to different interest rate. When you plot it based on what you're observing in the market, you get a yield curve. So generally speaking, yield curve are upward sloping. So in the shorter duration, you will have a lower interest rate. In the longer duration, you will have a higher interest rate. So generally, it's the upward sloping. This is the most common yield curve. So the treasury rates are in a way related to government securities. We are talking about US yield curve then, right? So interest rates, yield curve, treasuries, that's how it is related. Inflation is essentially an expectation of future rises in prices. So when you have a higher inflation expectation in the future, then you are expecting that the interest rates, right, are going to rise. Why? Because typically in the developed market like the US, they fight inflation by increasing the interest rates, short-end interest rates at least, right? So if you're expecting inflation to rise in the future, then interest rates are expected to rise, and therefore you expect the yield curve to be more steep. And in such an environment, then you can expect that the bond prices will start to drop, right? Those bonds with a longer tenure will drop more in prices compared to the bonds with shorter tenure. So I hope that you could appreciate what I've just described. And in terms of the so-called, the sensitivity of how the price will move is a concept called duration. And the longer tenure bonds tend to respond more to interest rate changes. So therefore, if you have a 30-year bond and then interest rate rises by 1%, you're going to see the 30-year interest 30-year bond fall by more compared to a 10-year bond. So therefore, duration is an important concept that you need to also understand vis-a-vis the yield curve and interest rates to understand how you should manage your own bond portfolio. For those who are already lost with what I've just described, these are exactly the reasons why you buy a bond fund. You follow me? So the next question is, what are the reasons to buy a bond fund than a specific bond? So that's a very good reason, because if you are buying a lot of specific bonds on your own, then you have to manage a lot of factors and pricing, and also so-called interest rates. A bond fund is essentially a collective instrument. The fund manager would manage collectively the investment on behalf of the investor for very small amounts invested, right? Few $1,000s, $1,000, depending on the minimum set by the fund. You can actually participate in a diversified portfolio. However, if you were to buy specific bonds, and here I'm talking about Singapore, okay, talking about Singapore, there are actually two broad markets: wholesale markets and retail markets. The wholesale market operate with accredited investors, more sophisticated investors and institutions. The bonds that are traded in the wholesale market, typically in Singapore dollars, would be 250,000, and in US dollars would be 200,000 US. That's the minimum size. Whereas in the retail market, the minimum size could be as little as $1,000 or $2,000. So if you are retail investors with a few $100,000 of retirement savings, then it is very difficult to buy wholesale bonds because the minimum sums are so big. And then you may only buy retail bonds, but then the universe of retail bonds in Singapore are not very big. So that is another reason for this group of investors to then buy a bond fund, because then through buying a collective instrument, you are able to access a diversified portfolio without being overly concentrated. Okay. All right. So I am not going to answer an economic question, macroeconomic question about the US inflation risk and the M2, right? So there are a lot of economists out there who are already giving an opinion on that. But if you were to take a step back, generally speaking, if there is a lot of government impetus in the economy, you are going to expect that there will be some amount of overheating in the future. Exactly when, it's anybody's guess. So therefore, you are going to expect that inflation would sooner or later creep in. And as I already mentioned earlier, inflation, interest rates, and bond prices are not good buddies. So therefore, if you expect inflation, bond prices would adjust. So just that would be my short answer to that macroeconomic question. Do you need a CDP account to apply for the Astrea VI Bond? So I briefly mentioned the Astrea VI Bond earlier. So this is a structured finance bond. It is repackaged, comprising of cash flow from a big portfolio of private equities, right? And then it's repackaged with certain structuring techniques in there into a bond. So when you are investing, you are actually buying a structured product in the form of a bond. And behind this structured product is actually a portfolio of private equity cash flow. So this bond has been rated by credit agencies. Actually, it's been rated since as early as Astrea IV. That was the first retail bond issued. And the retail tranche is rated single A, structured finance single A. So considered to be relatively investment grade or lower risk. So that's why it's offered in the retail market. To own bonds, you need to have a custody account, right? So if you are a retail investor or even a corporate investor in Singapore, typically you would open a custody account with CDP. CDP is the central depository. So CDP is actually a custodian who would hold securities, may be shares, may be bonds, anything that is traded on the stock exchange of Singapore, you can actually store it with CDP. So the answer is yes, you would need to have a CDP account in order to buy this Astrea VI Bond, but you only need to open the account once. And then this is an IPO. So to subscribe to this Astrea VI Bond, you need to have a bank account with the IPO agent bank, the local banks I think in particular DBS would be one. And then you can apply through the ATMs or through the internet banking. And if you are successful in the allocation, the shares, the bonds would then be credited into your CDP account. When you open a CDP account, you have to link your CDP account to a bank account so that the interest and coupons that you receive or dividends that you receive from CDP stock securities will be paid into your bank account. And if you have linked that up, then every 6 months when Astrea VI pays its interest, that interest will be automatically credited to your bank account in the simplest way, right? So if you sell, that proceeds will then be transferred to your brokerage account. So in order to buy and sell in the secondary market, after you have subscribed, then you need to have a brokerage account, and the brokerage account needs to be tied to this CDP account so that you can execute transactions through your brokerage account, either to buy in the secondary market or to sell the bonds that you have already bought. Okay, so I hope I've answered that question. Next question, it's about Singapore savings bond. So let me take a step back because I've not really talked about Singapore savings bond. So Singapore government bonds in the context of Singapore, right, in Singapore dollars would generally be considered as risk-free or at least very, very low risk, right? So in any market, any other currencies, the government bonds of that currency will be considered as the risk-free or the very, very low risk. So Singapore government bonds have been transacted for a long time, right? To buy the Singapore government bonds, you need to participate in the auction. Retail investors are a little bit more difficult to invest in that. So the government created the Singapore Savings Bond, which is a special tranche of these Singapore government bonds to allow individual investors, foreigners and locals to subscribe to it, right? The risk is the same in the sense that it is a government obligation, but you don't buy or sell this bond in the secondary market. You subscribe to it when the subscription period opens and you redeem. And when you redeem, you always get back the principal when the subscription window is open as well. So usually it opens at the beginning of the month and it ends at the end of the month. So to find out more information, just type Singapore Savings Bond in your internet search and you will be able to find out much more information of what I've just described, okay? So Singapore Savings Bond is a very suitable instrument for very risk-averse and low-risk investment. So emergency savings fund is something that you want to be not invested, but to be placed in a very low-risk instrument, because in an emergency, you want to be able to liquidate it and take the money out to be used, okay? And typically, people will put it in a bank deposit, right? The other instrument will be the Singapore Savings Bond, right? So Singapore Savings Bond is a good instrument for emergency savings fund, okay? Moving on, looking at the question. Can you explain what the call option for bond, Astrea bond means for retail investors? Okay, so the Astrea bond is structured for the retail tranche. Is structured to be matured in a period of 10 years, over a period of 10 years. So when you invest in day one, the legal final maturity would be year 10. But there is a mandatory call at year 5, and the call option has got a condition to attach to it. You need to go and look at the offering document to see what the conditions are. But this call option is on the issuer. Okay, so which means to say that instead of waiting 10 years, you potentially can get your money back at year 5. Okay, so that is the mandatory call date. So that is what it means by the call option. So are you getting your money back year 5 or getting your money back year 10? So they have simulated the portfolio, and generally speaking, if everything works according to plan, then you should get your money year 5 back. So that's the easiest way to understand it. That is the call option, the mandatory call at year 5. You should be able to get your money back at year 5. But should certain conditions not be fulfilled, so certain things turn bad, then the legal maturity is actually year 10. Right? Okay. Going down. How does one make sense of the bond stocks relationship? Historically, the correlation is low. March 2020 proof otherwise. Your thoughts, please. Security prices are driven by many factors, amongst which the most animist is actually greed, fear, panic, right? Security prices are fundamentally driven by a set of fundamental principles. Bonds, for example, by basic credit, basic interest rate environment. But at the same time, because bond prices can be bought at, or rather bonds can be bought and sold in the market, when in a situation whereby there's general panic, everybody is going to sell, starting from the easiest and the most liquid instrument onwards. Okay, so in a panic situation, which was like in March 2020, then you will find that a lot of securities are going to be moving in the same direction because people are selling whatever is easy to sell to raise cash. And as this panic deepens, the selling process goes faster, then you find that actually a lot of asset classes are going to move in the same direction. And it's a good question because March 2020, all you need to do now is look at March 2021 or even December 2020 or September 2020. That panic back in March 2020 would have been ancient history, right? Because global prices, in particular diversified portfolio, would have already recovered. Obviously, stock prices would have run up a lot faster than bond prices, okay? So pay attention to fundamentals, but sometimes during panic situations, you can have people panic sell. And if you fundamentally believe that your portfolio is well constructed and diversified, then you may not worry so much about that panic selling, okay? All right, which is why it's important to have a diversified portfolio. Moving down, the question on perpetual bonds. Okay, so what is perpetual bonds and how is it compared to plain vanilla bonds? So perpetual bonds have no maturity. That's why the word perpetual. Plain vanilla bonds typically refer to bonds with a fixed maturity date. So Astrea, I mentioned just now, is a legal maturity at year 10 with a call at year 5. Perpetual bonds has no maturity date. So in theory, legally, the issuer don't have to pay back the principal, which means to say you can receive interest every 6 months till kingdom come, which may not work very well for a lot of investors. So therefore, many perpetual bonds actually have a call date. And in the famous Hyflux case, there was also a call date. I cannot remember now whether it's a 5-year or 4-year or 6-year. But basically, at that point in time, the issuer has an option to call and return you the money. And if they don't call or return you the money, then it would continue. And there will be a set of conditions to govern that continuance. Whereas a plain vanilla fixed dated bond would mature at the end of its maturity. And if you were to be prepared to hold the bond till maturity, then you don't worry so much about the movement in the interest rate, because as long as the bond issuer don't default, then at the maturity, you will get back the full principal plus all the interest that you have earned in the meantime. One thing though, you need to remember what I said about duration just now, right? So bond prices are sensitive to movement in interest rate. The longer the bonds, the more it will get affected by movement in interest rate. So a perpetual bond has got the, in theory, infinite tenure, and therefore its impact on interest rates is going to be very significant. So in a down market, the volatility is going to be very, very significant. Perpetual bonds typically in the past were issued by very, very strong issuers like banks, insurance companies. But supply and demand means that many issuers have now gone down market. Corporates and some not so strong corporates are also issuing perpetual bonds. So be careful. What is bond yield? Is the yield to maturity or is it the coupon rate? Bond yield is a very general term that tells a person or investor what is the return of the bond. Okay, so simplistically put, a bond that pays a 3% coupon per annum, right? The bond yield would be very loosely 3%. You can say that. But you know that we are in finance, we are not laymen, right? So in finance, we have to be very exact. So when you purchase that bond, the price that you purchase that bond the remaining tenure to maturity, those affect the returns. So to say that the bond yield is equal to the coupon rate is not very exact. The most accurate matrix to use is what you just referred to as yield to maturity. Yield to maturity takes into account the internal rate of return of the various interest rates that coupons that you will receive over different periods, the initial price that you pay for, and the final value that you will get on maturity. Too complicated, go to the internet, you will be able to find a yield to maturity calculator. Key in initial price purchase, key in coupon rate, key in the face value on maturity, you will be able to find the yield to maturity. And this yield to maturity in percentage per annum can then be used to compare against different instruments, just like effective interest rate, okay? Okay, so I'm going to look at the third question, which is the SSB. SSB stands for Singapore Savings Bond, So when buying Singapore Savings Bond, even via online banking, the buyer needs to declare that he's physically present in Singapore. Can you enlighten the rationale of this requirement? Okay, this particular question, I will have to go back and look at the criteria, or rather the FAQ for SSB. Unfortunately, I cannot answer you this question about the rationale of that declaration. This is a declaration required by the institution in order to issue you this SSB. As far as I am aware, okay, you have to be a retail person, whether individual or foreigner, above age 18, and to have a CDP account and an individual CDP account for that matter. You cannot subscribe to SSB using a joint account, right? Why is that the case? Because there's the individual limit placed on individuals. You cannot own more than $200,000 of Singapore Savings Bond. So they need it to be a single name account in order to track this criteria. So if you use a joint account, they can't really track that. So sorry, I can't answer this question about the rationale. You may want to go to the Singapore Savings Bond website to find out more. Okay, let me look. So there's a question on call option. Wow, this anonymous participants is heavy into option topics. Okay, never mind. If the issuer doesn't exercise the call option, okay, so it's important when we talk about option, right? Who has the right to exercise the option? Okay, so in this case, we are referring loosely, generally speaking, to call options whereby the issuer has the right to exercise, not the investor. If the issuer doesn't exercise the call option and the interest rate has fallen, okay, so let's think through. If interest rate has fallen, meaning that the issuer would be able to borrow at a lower interest rate, right? So it will be beneficial for the issuer. The issuer will be able to go out and borrow at a lower interest rate. Does this suggest that they don't have the cash and therefore could be a trouble ahead? So what did I just say? Call option to the issuer, interest rate has fallen, means that the issuer under normal circumstances should be able to go out and borrow at the lower interest rate. So it makes sense for the issuer to say, call the money, return the money back to you. Thank you for being with me. I'm going to issue a new bond at a lower interest rate. Does that make sense? The fact that the issuer doesn't do that gives you already an inkling that maybe they have no way of paying you back. Okay, because in order to issue a new bond, they need to retire the old bond first. Okay, and remember when I said about due diligence, use of proceeds, very important, right? If the issuer is going to say, I issue a new bond today and the proceeds will be used immediately in 2 weeks' time to repay this more expensive bond, then you would probably be wondering why is that the case, right? So no issuer is going to say that, right? So typically If the issuer want to refinance, then they either must have cash or they have to borrow from banks. Okay. Otherwise, they have no means, and so they will not call and they will continue. And in the case of Hyflux, if they had continued, they would have incentivized the investor with a pickup in the interest rate margin. I think it was 2%, if I'm not mistaken. And I stand corrected because I haven't looked at the case more recently. So in the case, in the case of Hyflux, there was a step-up interest rate. So which means to say in a perpetual bond situation with a call option, there's no step-up interest rate, then it is not so normal, right? Not so favorable to you, because then the issuer have all the rights in the world to decide whether or not to call, because there is no incentive for him to do otherwise. Okay. So please keep the live questions coming by typing inside the comments box. Otherwise, we are going to look at some of the older questions that have been asked before this evening. And one of the questions asked very early on when we first publicized this Ask Me Anything series was, how do I choose between different ETFs? So here the participant is thinking of investing in a bond ETF, all right, and wondering how he chooses between different bond ETF. I would say that generally speaking, the criteria for choosing between different ETFs, it's quite similar. In fact, the criteria for choosing between ETFs or different unit trusts are fairly similar as well. So there are some similar criteria. One of the important criteria is to ask yourself, what is the investment objective or the investment mandate of this fund, this ETF? Okay, does it meet your investment objective, right? Does the risk return profile meet your risk appetite and your investment objective? So that's important. Second is the size of the ETF or the size of the fund. Now, bigger funds tends to be more liquid, meaning to say that you will be able to buy and sell easier. The bid and ask price would be closer, just like to buy a blue chip share versus to buy a penny stock. So a bigger ETF would allow you to have better liquidity. And in collective investment, there is a matrix called total expense ratio. Total expense ratio is simply the administrative expense or the expenses, not the transaction cost, the expenses of the fund divided by the total value of the fund. So generally speaking, a bigger fund will have these expenses defrayed over more dollars, and so therefore the expense ratio will be lower. So total expense ratio is a good matrix to look at. All things equal, the one with the lower total expense ratio should be a better investment, all things equal. Okay, why? Because if the investment mandates are the same, the investment style, the types of investments, the markets, why should you pay more if the returns are exactly the same for a higher expense ratio fund compared to a lower expense ratio fund? Okay, so TER is a very important matrix. And then typically equities ETF will have a higher ratio, bonds ETF would have a lower ratio. Then there are others, right? Look at whether it is a cash-based ETF, which means to say that there is no derivatives inside there, or is it a synthetic ETF? A synthetic ETF is basically structured and created using derivatives by investment banks. What is the difference? A synthetic ETF will have more risk, not necessarily higher, but more risk because of the structure, counterparties, and so on and so forth. So generally speaking, all things equal, it is probably better to invest in a cash-based ETF. What you see is what you get versus a synthetic ETF. But some markets don't allow you to invest directly, and so therefore, perhaps a cash-based ETF is not so straightforward. Okay, so that's the question about how to choose between ETF. And of course, you look at performance, historical performance, right? Historical performance. All right. So next question is, SIA has this perpetual bond, but I can't sell as there's no active market. Got it through the rights issue. What can I do if I want to liquidate? So I think this is a bond that got packaged together with the recent fundraising exercise, if I'm not mistaken, last year. And it is a bond with certain characteristics attached to it. It is it should be traded. And if there's no active market, means that basically you want to sell, but nobody wants to buy. Yeah, it's going to be quite difficult for you to sell an instrument whereby there's no active market. It is possible to have an off-market match between two participants, but unless you are a big player, the cost of entering into an off-market match is going to be quite prohibitive. So I would say if you have small amounts of that, then you probably have to hold on to it until the market improves and you're able to liquidate, right? So that is the answer to that question, and I stand corrected in the sense that I have not personally read the prospectus, and so therefore I'm not totally familiar with all the terms and conditions of the instrument you just mentioned, but I wanted to comment on the active market part. So this question relates to other instruments as well. When there is no active market, then it means the liquidity is very, very low. Then it's an instrument that is difficult to buy and difficult to sell, right? So it's not a very good instrument to get yourself into. Next question is about investors so hungry for yield. So a lot of investors are hungry for yield. Why? Because interest rates are so low. A few months ago, the 10-year interest rate in Singapore was less than 1%. Okay, so the current tranche of the Singapore savings bond, fortunately, has gone up above 1%. So everybody is trying to chase for yield. So Astrea 4 compared to Astrea 5 compared to Astrea 6, the pricing has gone from 4 point something, 3 point something now. I think it's 3 or just 3 plus a little bit, okay? So what are your thoughts on high yields and bond funds? Risk and return, right? So if you are hungry for returns, then you must understand that you are taking on higher risk. So if you want to take on higher risk so that you have better yield, then you must have the stomach to stomach the additional risk and volatility. More importantly, it should fit within your investment horizon, investment objective, and risk appetite. Okay, risk return appetite. So I think that is an important criteria. Don't follow the crowd to chase yield as it gets lower and lower, which means to say you take on more and more risk in order to get the same returns, right? But having said that, there's also a place for high yield bonds. High yield bonds, in case some of you are wondering what it is, it means that non-investment grade, typically non-investment grade, double B, triple B minus type, or even single B type bonds, because the returns are a bit higher compared to investment grade. Okay. Next question, what happens when a bond issuer goes bankrupt? And this will be the last question I will take this evening because we are very quickly approaching the end of the hour. What happens when a bond issuer goes bankrupt? Are there any protection measures for the investors? So you need to go back to look at the bond document, right? The bond document that is held by the trustee that sets out the terms and conditions of this particular bond issue. And more importantly, you need to look at what are some of the terms and conditions inside there that can help to protect investors. Generally speaking, these terms and conditions are rather boilerplate. Okay, so therefore, you will find that there is not much redress for investors. And most bonds are not secured, so there's also no underlying collateral. So which means to say if the bond issuer goes bankrupt, then you are likely to have to join the pool with all other creditors to wait for your money. And in a debt restructuring, right, there is a priority of votes, priority of claims, but the restructuring process is quite complex. So sometimes even investors with small votes or small priority of claims can torpedo a restructuring and basically drag it out. So which means to say that the value destruction would increase very significantly. The longer you are dragged out in a restructuring, the higher the value the destruction. So the protective measure for you as an investor is to do something before the bond issuer go bankrupt. So remember, I had the list of the things you need to do: take action, talk to the bond issuing bank, the mandated bank, talk to your financial advisor, try to get ahead of the queue before the issuer goes bankrupt. Once it goes bankrupt, it's much more challenging for investors to help themselves. Okay, so with that, I am going to end the sharing session. All right, and I am going to go back to my PowerPoint and give you a bit of a teaser. All right, so after bonds, what's next? After bonds, what's next? So our next session will come on live 2 weeks from now, 24th of March, 2021, on a Wednesday evening, same time, 7:30, same place, Facebook Live on IFL page. It would be on insurance, specifically life insurance, and questions like how much life insurance should you have? How should you choose between insurance product? Should you buy term or should you buy whole life insurance? These questions and many more that you would ask either in the next 2 weeks or live on Wednesday, the 24th of March. Our panelists will answer those questions on Wednesday itself on our next Facebook Live session. Being an inaugural session this evening, we do value your feedback. So the QR code there is for you to scan with your mobile device, bring you to an anonymous survey monkey page. Please give us your honest feedback so that we can improve upon this session. And the next session will get better and better and better. For more inquiries and contact to Institute for Financial Literacy, our phone number and email address is there. Our website is ifl.org.sg. If you go to our website, you will be able to sign up for other online workshops, not Ask Me Anything, but online workshops whereby we can share with you information on other financial topics. Stay tuned to our Facebook page. Go to our website. And now I'm going to go silent while you do that feedback. Thank you very much this evening for being here with us.